Okay, welcome everybody. Thank you for joining us for today's webinar. My name's Megan Stewart. I'm a Client Director in the Brisbane office at Vantage Performance, and I'll be your moderator for today. Today we're presenting the importance of Safe Harbour ahead of September 2020. We've got a full Vantage lineup today. We've got Kevin Higgins hosting again with Michael Fingland and Macaire Bromley as our guests. So just a little bit of housekeeping before we get started for those who haven't joined one of our webinars. We've got 30 minutes of content to cover, followed by questions. If you have any questions during the presentation, please type them into the question box in your Zoom control panel. You'll see the question and answer module at the bottom of your screen as per the diagram. So I'll now hand over to Kevin Higgins. He's the Queensland Executive Director of our Brisbane office, and he'll introduce Michael and Macaire.
Okay, thank you, Megan. And welcome to the Vantage Resilience series as we discuss strategies for making businesses stronger, more resilient. Today we're looking at discussing the importance of Safe Harbour ahead of September 20. As many of you know, the moratorium for insolvent trading concludes on the 25th of September. So given that, the number of companies may need 2 or 3 months to actually get Safe Harbour compliant before that deadline comes about. So it's actually critical to start that process now, kind of July, August. There's a number of common misconceptions about Safe Harbour and how it operates, which is actually hindering its use. So hopefully we'll have a chat about that today. I've got 2 panelists today. The first panelist is Macaire Bromley, who's recently been appointed Executive Director at Vantage in Sydney, or leading our Sydney practice. And Macaire is actually a Safe Harbour specialist, having been instrumental in lobbying the government for law reform at its highest levels, including the PM's office. And she was instrumental in crafting the text of the law. So welcome, Macaire. Great to have you here today. And second panelist is Michael Fingland. He's the CEO and founder of Vantage more than 15 years ago. He needs no introduction. So both Macaire and Michael have 25 years experience in turnaround and restructuring. I see just on that infographic, Michael, to reiterate, with 160 successful engagements, 90% success rate, and in excess of 18,000 jobs saved in that last 15 years. You must have a great team behind you, I think, to achieve those results. Before we go on to our traditional kind of opening with poll questions, Michael, can you just briefly give us a set the scene for us on VA versus turnaround / Safe Harbour?
Yeah, thanks, Kevin. I mean, sort of set the scene. I mean, this is the way we certainly look at it. Turnaround is a game of confidence. When you boil it all down, that's what turnaround is all about. Is do you have a plan, a series of actions, the right people around you, the right access to capital, etc., to either maintain or rebuild support of incumbent stakeholders, which is as broad as that sounds, but also to secure the comfort and confidence of incoming capital providers, etc. So that's certainly the way you look at this. And Safe Harbour is the ultimate sort of confidence tool. That's what this is all about, and we'll talk through that today and why it's working so well, because it does instill confidence in financiers, boards, and other stakeholders. And that, as that diagram suggests, it was designed to give boards the choice to be able to say, do we head down the turnaround route, or do we go the VA route? And Safe Harbour is just an enabler. It's a tool to enable a comprehensive turnaround to take place. So that's really what it was designed to do. It's working, and we'll talk through why, as I said today. But
right. Okay, thank you very much for that. So we'll start off as tradition would have it with a couple of poll questions. The first is, have you or your client actually been through a Safe Harbour process? So it's yes, no, or it might be you've tried but you didn't meet the criteria. So we'll give you about 10 seconds to answer that. And then the next poll question under that is, do you believe Safe Harbour is just for insolvent businesses? And that's a yes, no, don't know type question. So, if you've been through a Safe Harbour process, it might be your client, or you might be a banker looking at your customer, or it might be an accountant looking at your client. So just look at it through that lens, and we'll see how we went with that.
Yeah, so we've got 60% of people that have voted so far, and we'll probably close it off there. So quite interesting, we've got an even split for question 1. I'll just share the results to the screen now, but we've got essentially half the audience have been involved in a Safe Harbour process and half have not. And we've got 78% of the audience who don't believe that Safe Harbour is just for insolvent businesses. So I'll leave that to you guys to talk through those results.
Yeah, great. Okay, well, thanks for that, Megan. And that's probably a good segue onto the first question, Macaire, is what, given you were involved in that kind of initial drafting and think tank in relation to the legislation, what's the intention behind Safe Harbour provisions within the Corporations Act?
Yeah, thanks, Kevin, and thanks everyone for joining today. So Safe Harbour for me was a very personal journey that began for me when I returned from London. So having worked in Sydney for many, many years, and then as many of us do, worked overseas for a while and came home, I guess, with that sort of fresh perspective that you get when you step out of an industry for a while and then step back in. And one of the main concerns for me being at the deal table was the inability of our director pool, the inability of the company to actually acknowledge its problem, because it can't acknowledge insolvency. And if you can't acknowledge that you've got financial concerns, then you can't fix the problem. And so you're doing a lot of, boards and their CFO teams are doing a lot of backpedaling, trying to fill in financial data to justify continuing to trade, when in fact what we need them to do is actually have really clear, accurate data that says, okay, this is where you're at, what are we going to do to fix it? And so insolvent trading was one of the key issues and the key factors driving those behaviours. So we needed to attack insolvent trading and give directors and boards and all of the stakeholders at the deal table breathing space and the opportunity to actually honestly address, okay, what's going on, what's our plan, and how do we fix it? So, so the intent behind Safe Harbour, albeit it sits as a technical aspect in insolvent trading and within that guise, that's not the intent, that's not the foundation. The foundation is to give directors a real a framework and a real genuine set of guidelines that informs their decision making and gives them the tools of, okay, how do I do this? I've not been in a crisis before, but what should I be thinking about as a board? And that's the intention. And so you can see, as I'm talking through some of the intention, you can see how that then is brought out in some of the language, which, we can address in a little more detail.
Great. Okay. Well, I guess one question that might be in some directors' minds is entering Safe Harbour an admission of insolvency?
Yeah, and I think it's really important to address this straight up as a no. Insolvency is a separate set of considerations and criteria. It's great to see there in the poll that the majority of attendees today understand and appreciate that. But if I can just really emphasise the point that, particularly for the advisors on the call, is that what we're not trying to do is cram Safe Harbour into the technical aspect of the Act that says you suspect or are insolvent. That really is a complete distraction. The question is, do you as a board have financial concerns? And if so, here we can help you. Here's a framework that guides you. And if in the end you do, if in the end it is determined that throughout that period or for some of it, you were insolvent, that's just not the focus for the board in the moment. That will be determined later in time if the company falls over. But it should not be the focus. It's an absolute distraction at the time of dealing with the turnaround plan. During the Safe Harbour process, we're focused on our plan, how are we going to get you through this, how are we going to achieve a better outcome, and of course bolstered by the other elements of the Act.
Okay. You mentioned framework there before. And how does the Safe Harbour framework, and I know you've done an article on this recently, but how does the framework mitigate against any risk of a company failing?
Yeah, so some of course, the identified problems then feed into, well, what is the framework? What is the answer? So key identified problems were not able to actually identify the issues, not able really to prepare accurate financial data which exposes the issues, and then not having a plan because you're not acknowledging the issues. So of course that then feeds very directly into the framework. We want you to have a plan. We want you to have a really clear plan. And what should that plan be? Well, let's test it against the worst case alternative. And as long as you as a board of director are constantly testing the counter, the counter solution would be, we don't know how to get through, so we'll appoint. Okay, well, let's just make sure that at all relevant times, we're comfortable our plan is better than that. And as long as you are satisfied that it's reasonably better, then you're on track. The second key element that is derived in the framework, and you can see there is absolutely no point in my experience and our experience at Vantage in having a plan off of inaccurate financials. So what do I mean? Of course, sometimes we have fraud, but more often than not, we don't have fraud or misconduct. More often than not, we just have a way of operating that has served the company in good times for years and years, a way of accounting, for example. But it's not wrong. It's just that it can hide what's actually happening in the business. And so we want to drill down right into what's actually happening, get really good, accurate data and timely data so that when we create a plan, we can have, and the board can have, absolute confidence in that plan.
Just to add to that too, I mean, Safe Harbour, is all about improving the rate of business success or reducing the rate of corporate failure, whichever way you look at this. That's what it's intended to do, and it's never been more important than now, or through any downturn or recession, that we are going to see a wave of collapses anyway. So this is going to help prevent a lot of those. But it's an early intervention tool. I mean, that's the way. Yes, there's technical compliance steps in it, as Macaire has talked about. Under the overarching plan, is this better than the alternative? But at the end of the day, it's an early intervention tool, which is why we've seen a whole range of typical stakeholders in the market, financiers, lawyers, accountants, using this as a intro to their clients to get help, rather than saying you should go and talk to a turnaround professional, and there's still 1,000 definitions out there as to what that is, or a restructuring professional. If they're using it as a hook, as an easier way, a softer way to introduce the concept of getting some specialist help. Now, a turnaround engagement, invariably always follows from that Safe Harbour discussion, because to get into Safe Harbour, you need a plan, you need to have 3 ways in cash flows and supportive stakeholders and access to capital, whatever it might be. So it's just acting as a conversation starter. I mean, that's as simple as it is. It's acting as a fantastic conversation starter. So financiers can get their client to get help earlier than they otherwise would, which is always their biggest frustration, whether it's still in the line or it's going to work out, is getting the client to actually acknowledge they need some help, as you said before, and go down that track of getting some help. So that's, people can overcomplicate Safe Harbour. It's a very simple framework. It's a really simple framework, the way it finally got drafted. And it's just an add-on to a normal phase 1 turnaround. To that point, 90% of our turnarounds now start with a Safe Harbour engagement. The only ones that haven't is that they've already got a Safe Harbour advisor in there. So it's just an add-on at the start. It's actually quite a simple process. And the key is not to overthink it. It's actually quite a simple framework.
Yeah. And I think the best feedback I've had on it is from the board. If we can get the messaging out that Safe Harbour is not an insolvency tool, it's a best practice restructuring framework. The feedback from the directors that we're working with is that it gives them absolute peace of mind. They go from this position of chaos, not really knowing, particularly at the moment in really uncertain financial times, how do I respond? What should I be doing? It absolutely crystallizes in the mind of the board. Okay, I should be doing this as long as it's better. And the second my advisor says it's not better, there is no emotion now attached to that decision of what do I do. Of course, it's an emotional decision, but it's founded now on objective fact I need to appoint. So no, that pre-Safe Harbour was a really fraught. I've sat at deal tables with boards in the boardroom having to make that call. It is fraught. They're thinking of shareholders, they're thinking of employees. The last thing I want to do is appoint a VA. But now with Safe Harbour, it's peace of mind. It is an objective decision based on fact. Is what I'm doing better? Yes or no? Yes, great, keep going. No, appoint a VA.
Yeah.
Well, just to that point, I mean, there's evidence of the fact that it provides that ultimate peace of mind tool, which it does. And we've done 25 or so Safe Harbour engagements of the ones that are still ongoing. Only one, because obviously, when the Safe Harbour moratorium, so the insolvent trading moratorium kicked in March and goes till September, as we know, only one client stopped the monitoring on the way through, because it provides that peace of mind, that extra governance. Because at the end of the day, Safe Harbour, the framework, is just best practice governance, best practice systems and processes. And most boards actually realise that very quickly. Yes, you need to help us craft the plan, but maintaining books and records and lodging on time and paying entitlements on time, those sort of things, it's actually just best practice governance. So, and it's actually quite a light touch monitoring program on the way through. So as I said, all bar one continued with all the monitoring all the way through there, even though insolvent trading provisions have been suspended. And the only reason why they stopped is because it was a large listed $1.2 billion group. We did the Safe Harbour assessment, but they had enough of other advisors around them. We gave them the monitoring framework, and they didn't need another monitoring mechanism. So, it is providing that ultimate peace of mind.
And just picking up, Michael, on that point of it is simple framework. I think some of the community is sort of seen it the wrong way around. They're looking at some of the criteria around compliance with employees and tax, and things that the court will have regard to around financials and the appointment of an expert. And they're actually looking at it the wrong way. They're sort of focusing in on those elements, whereas actually that's not quite the law. The law is, do you as a board, are you confident you have a plan that's going to deliver a better outcome than VA or liquidation? That's the test. There is the compliance aspect, and you don't even get across the line if you've got issues around employees and tax. Okay, they're tick box things that we need to check. But in terms of the criteria that we look at, they're just things that a court might have regard to, or probably will have regard to, because they're listed. So as a board, I would want to have regard to them all. But remember, they're the criteria that the court will have regard to test, was that plan, did that plan have reasonable prospects of being better? That's how those other things are to be considered in terms of considering the plan, but it all goes back to the plan.
Yeah, no, it's a really important point, that peace of mind. And I know it's a question that we always ask before we start an engagement with the director. Our opening question is, what's keeping you up at night? And that helps tease out what those three key issues are in the business. But with Safe Harbour, they can sleep at night, and whilst we're dealing with those key issues. So really important part. We're kind of halfway through. We might break just to do another quick poll. So this is to test if people are still kind of with us and awake, but not that it's not an interesting topic. But do you think that Safe Harbour is just for large corporates? That's another, I guess, common question that we get asked. It's a yes, no, or don't know. So yeah, that'll be interesting to see what the results are, and we'll move on to a couple other questions. We've got about 10 minutes left, so we've got another couple of questions to go. But how'd you go, Megan?
Yeah, we've got the majority of the results in now, so I'll just close that off in a second. But we've got just shy of 80% of respondents saying that they don't think it's just for large corporates, which is good. So yeah, I'll hand over to you, Kevin, to you, Michael, just to talk about some stats surrounding that.
Yeah, well, that's good segue. Michael, is in your opinion, is Safe Harbour just for large corporates?
Yeah, I mean, as I said before, we've done 25 or so of these. Just over half of those were sort of 15 to $100 million turnover sort of clients, and the other ones are above that. So, and look, early on in the Safe Harbour sort of journey, there was that common misconception out there that it was too costly for most businesses, but it's all relative to size. So, pleased to see that the vast majority of the audience agree that it's a tool for large and small.
Yep. Well, you mentioned 25 projects there. What would you say are the biggest learnings from the Safe Harbour framework in practice?
Yeah, and that's really the guts of what we want to talk about today is that, you know, and some of the traps that we sort of discovered along the way to make sure that clients do comply. Like, just to start with a very simple one, FBT. Okay, so as most people will know, you've got to stay compliant with your, you know, with lodging, you know, taxation returns on time. We had a couple early on that through our checklist process turned out that there were a couple of entities in the group that were never registered for FBT but should have been, and they were never aware. So technically, that entity would have fallen foul of the Safe Harbour regime because, and these entities have been trading for 10 years or so. So we had to quickly get all the historic returns lodged and estimated. So so that's a trick for a trap for those that are doing Safe Harbour. Make sure you're assessing whether those companies should have been registered for FBT. It's a really easy one to sort of fall foul on. SGC, again, you know, we're starting to see the ATO doing a lot more SGC audits on whether you're negotiating a payment plan that triggers an audit, or you've got an employee that might have complained about super not being paid on time, which triggers an audit. So, you know, whilst you know, as a Safe Harbour advisor, your role is not to audit the company, and you never can. That's why you get management rep letters from clients, and that's another learning. Make sure you always have management rep letters confirming that, you know, the CEO and the CFO believe that, you know, employee entitlements were paid on time, et cetera, because we've seen, you know, a lot of large businesses come out in the last year or so with underpayment of millions of dollars worth of entitlements and wages over the years. So, yeah, make sure you're not auditing and rubber stamping that they haven't paid on time, that they have paid on time, I should say. Always get those management rep letters. Financiers have really embraced it. I mean, without fail, every time that we start a turnaround gig now, the financiers are always asking us, are we also doing the Safe Harbour role? So it's got into the psyche of financiers, which is a big lesson. You know, that leads on to, you know, another critical one at the moment is, you know, we're coming up against a wave of distressed refis, right? There's no other way through this. There's going to be a lot of requirements for businesses to be refied, and incumbent financiers might have to take a compromise to avoid a VA scenario. But, and this is a really important sort of recent development that we've seen with one of the big four, and I suspect the other three will follow, is if they are presented with, you know, will you take a check for 70 cents the dollar versus a VA, they're now going to be starting to ask, well, have you also considered Safe Harbour? Because this should always be a last resort. You know, taking a haircut or a VA should always be the last resort. So they're going to start asking now, have you considered Safe Harbour and all the benefits that provides to buy you that more time to come up with a better solution? It might be at the end of the day, there might still need to be a compromise, but don't assume that you know, you can sort of jump to that conclusion, even though it is going to be required, you know, up and down the stack. The banks are going to be starting to ask more and more, have you considered, are you in Safe Harbour? Banks are asking, you know, if you're asking them to go into a standstill or due to forbearance or just a covenant waiver period, often a condition of ongoing support will be that you're in Safe Harbour or that you're committed to go into Safe Harbour, because it provides protection for financiers as well as for directors for all the obvious reasons. So, you know, another key thing that we've found over the last 2.5 years is incoming financiers into a distress situation. They're often putting it as a condition of their term sheet that you've gone into Safe Harbour. So again, you know, boards need to be very cognizant of that, and their legal and accounting advisors particularly need to be aware of that, but that's likely to be a condition. So the quicker you kind of get into that framework, the more time and solutions will be available to you.
So Michael, we've just got a question from the audience in regards to that. They've just asked if, in your experience, or I guess in Vantage's experience, does being in Safe Harbour impact on a company's ability to source further funding?
Yeah, it improves it. So as I said before, if you look at Safe Harbour and turnaround, it's all about confidence. And Safe Harbour improves the confidence of the stakeholders around you, because you've got someone else. Whilst if you've got a chief restructuring officer in place, which is what we typically do as our model, I mean, the Safe Harbour advisor is just endorsing that we've got a viable plan. I mean, that's why the extra confidence comes there. So as I said, it provides comfort for incoming financiers, incumbent financiers, let alone all the other stakeholders around them. So it does enhance your ability to attract capital.
I think I think it's that classic. If as a company you've brought in an expert to help you with your plan, then, and as a company, as part of that process, the expert is helping you have quality data. And what that means is when you go to the debt to secure new debt or restructure your debt, you're going with Advantage or someone like us who knows the market, who is credible in the market, understands what the debt needs. So we're able to present the business in a way that is honest, it's transparent. It gives the lender, the existing lenders or the new money providers, absolute visibility over where the company is, in a way that often companies struggle to do alone because they just don't have that expertise. So certainly if you get an expert in that does this all the time and knows the market, absolutely it increases your chances of bringing in new money or delivering on a debt restructuring. And of course, if you can deliver on that, then you are radically increasing your prospects of avoiding insolvency.
And you know, this is back to your question before too, Kev, around other learnings. I mean, it might be required as part of a comprehensive restructure of a group of 5 to 15 to 100 entities that you might still need to actually conduct a pre kind of planned VA of some of the entities in the group, right, as part of that restructure. And that's been the interesting sort of insight over the last 2.5 years of the different ways that Safe Harbour is being used. You know, you might think that it's just being used as a traditional kind of straight up and down turnaround, but it's being used, and it will be used a lot over the next few months as we are at the moment, where you're in the pre-planning of a VA scenario where that is the only way through this to keep the core business going. You might have to restructure some of the entities, some of the subsidiaries. So go into Safe Harbour, so you're protected while you're doing all that pre-planning. Now that's been one way it's been used quite effectively. There's going to be a lot of distressed M&A, a lot of distressed sale of assets, etc. So drop into Safe Harbour while you're offloading those assets for cash flow or debt reduction, whatever. And that's with an added bonus now with that is with the new anti or creditor disposition law that's come into place. Being in Safe Harbour protects you if it's deemed later on that you sold an asset for undervalue or perceived to be. Not only are the directors protected there, but the financiers, advisors, lawyers, etc., everyone around that transaction can be potentially targeted by the liquidator should that happen. So Safe Harbour prevents any issues around because the carve out, you can't be sued for disposing of assets. The other one which we've seen used quite well is where you're in a VC funded business where you might have had the first 2 or 3 rounds away and the board's not, and this is pre-COVID, so it's even more important now, where the board may not be super confident they'll get the next round of funding away. So the business might be in sort of the pre-revenue, positive cash flow phase, which is part of the normal planned sort of startup phase, but drop into Safe Harbour in case you don't get the next round of funding away. So it's being used very creatively, not just for the straight up and down turnarounds that you might think. And it's going to be used in conjunction with a lot of planned VAs and distress sale events where, unfortunately, due to the sort of black swan event we've had, a lot of, typical turnarounds, will need some sort of debt restructuring, formal or informal, whether that's the banks, converting debt to equity, agreeing to a compromise as part of an exit plan. But again, attracting that capital to enable that to happen, more often than not, you're going to be asked, are you in Safe Harbour or are you going into Safe Harbour? Because it just helps take a lot of the bluff off the table as well, that this is the right deal, it is the last resort deal, which you should always be, doing anyway, so you can actually execute some of these transactions as quickly as you can.
Just on the pre-planning and looking at pre-packs, etc. That's the other great aspect of Safe Harbour. It does require the board to be thinking of contingency planning. Why? Because you have to test it against the alternative. So it actually turns your mind just not to what are we doing, but what's the contingency plan? What would this look like if we considered a pre-planned DOCA and actually planned this and sensibly used voluntary administration as part of the turnaround as it was originally intended to be used. So it allows the board to be thinking about A, contingency plan, and B, thinking about the alternatives and genuinely considering them as they should do. There's just a compliance point too that Michael made that I just wanted to pick up for all the advisors on the call, but also for the boards of directors. Michael made the point, he sort of identified a few things, for example, underpayment of wages because you're not complying with the award, not registered for FBT because you didn't lodge your SGC statement because you just inadvertently forgot to. These are all going to be compliance issues that can come and bite you that will need to be remedied to access Safe Harbour. So what's the role of the advisor and the board? The role of the advisor is to ask the intelligent question. As Michael said, we're not here to audit. We don't have the luxury of time, and it's not our role. Ultimately, it's the role of the board to be comfortable that your company is compliant. And so it does fall on you as a board of directors to have that comfort. But where we can come and assist you is ask those intelligent questions based on, 25 deals that we've worked on to give us sort of insight into where do we see the potential traps for you to be aware of.
Yeah, I mean, Safe Harbour and the Safe Harbour advisor should be maintaining a Safe Harbour file, right? Virtual or otherwise. So if the unfortunate event happened and you end up in liquidation, you can provide that file to say to a liquidator, look, knock yourself out. There's no question the client was in Safe Harbour. Here's the proof. Here's the evidence, etc. So that's one hurdle they have to try and get over before they even look at an insolvent trading claim. So as part of that, one of the key tests I think that everyone should be doing, boards and advisors, is because that objective test is this plan still better? And your plan could be that we're going to do an informal compromise where financiers take a 70% check to either exit or whatever. We might be doing compromises with creditors, etc. So if that's still better than an immediate BA liquidation, then that's still a viable plan. Yeah. So again, it's going to be used very creatively on the way through. But one of the things that often comes up is, around lessons learned is, who should be engaged. So in our experience, we've done, I don't know, 7 or 8 listed companies now. We always say to the board, you can either engage us directly or we can go via the lawyer for privilege reasons. So in our experience, I think all bar one listed company, I think all of them have suggested or prefer that we go in via the lawyer so they can then choose what information to provide to a liquidator later on should they have to. Fortunately, that hasn't happened. Private, SME, family-owned businesses, they, not as concerned. So they're all going direct to, all of our engagements are direct to corporate. So our view is give the board a choice. Let them know the pros of going via a lawyer or direct, and let them make that choice. But that's our experience. Is listeds are adopting the lawyer approach, and privates are preferring the direct approach. But and one of the other findings as well is the do you get engaged directly to the directors or to the company? Either or. I mean, it's neither here nor there.
Yep, great. Well, I know we're at our halfway mark, but I'll just ask one final question, Michael, before we go into open it up for questions. But as I mentioned before, the government support packages are coming to an end. Liquidity issues are starting to become prevalent. What are the 2 or 3 things that companies should start to think about now?
Well, because of COVID and the rapid shutdown, if they're not already in Safe Harbour, obviously, there's been so much disruption to business models. So a lot of them might need a month or 2 to actually become Safe Harbour compliant, particularly if they've fallen behind in lodgements and they've got redundancies they haven't paid, etc. So, there's going to be this massive rush. If you've left till the 22nd or 25th of September to think about Safe Harbour, odds are you're going to be, non-compliant for a little period before you get that protection. So because of the massive disruption, you're going to need a month or 2 potentially for some of these listed or down to SME to get compliant.
Or can I just say, you might be compliant, but you're not going to get any advisor that can walk in the door and say you are day one. So as a board, you're in a really vulnerable, exposed position while you wait for your advisors to be able to ask their sensible questions, and assist you to check that you're getting, that you have things in place. Yep. So even if you think you can leave it to the last minute, you are going to be exposed for the period of time that it takes your advisor to get their advice to you. And they need a minimum of several weeks, depending on, for larger companies, they will need much longer. So do give your advisors time, boards of directors, to get yourself that comfort.
I think the other key thing, Kev, is from March till now, and this will sound flippant, and it's not meant to be, that's been the easy bit for a lot of businesses because, there's been so much pumped into the economy through JobKeeper. Banks have been very, very, company friendly. Tax office have adjourned payments, no stat demand. So unless you're a critical supplier to the company, you haven't been paid and won't be until September. So, but that first round of negotiations with landlords, etc., that's been the easy bit. The hard negotiations, the next round of negotiations are just kicking off now, effectively, because that first initial stimulus was akin to sort of 3 to 4 months worth of a cash flow boost, which is effectively now coming to an end. So the next 3 months is going to be so critical to survive. And no one's really talking about this issue, but if you've got JobKeeper, you can kind of limp through to September. But for a lot of businesses that only were down 15, 20% of revenue, they can't access JobKeeper. But as we know, most SMEs around the country, if they're down 20% of revenue, they're underwater, and they don't have as much access to stimulus as other companies that have actually been impacted larger. So I think we're going to start to see that wave of collapses and those needing that additional support starting to roll out now. So I don't think it's going to be nothing and then a big avalanche come September. You're going to start to see a lot of collapses from here, unfortunately. So again, come back to, if you want to try and access capital to bridge you through to that period, Safe Harbour is that confidence tool, and that'll give confidence to your existing and incoming financiers to help bridge that period.
Can I just say, often the question you get the company that they really want to involve you, but they can't afford you. They're looking, they're exhausting, they've exhausted all the government relief, and they're actually genuinely cash poor. And what we at Vantage do, and I'm sure there are other advisors that may do similarly, but we'll actually ask the client to see, show us your cash flow, because one of the skills of turnaround, and the very first thing you're doing is you're pushing out that cash flow. You're buying yourself time. So there are certain levers that we will always pull to push out the cash flow. And so we can immediately give directors and boards confidence that not only are we able to push that cash flow out to buy you time to do the restructure, but we can achieve you some really quick savings. And as soon as they understand that, and as soon as they start to see what the art of the possible is, then of course you've achieved savings for them to achieve your fee. So, that question of I want you on, but I can't afford you, I just, go and talk to your expert advisor, because if they are genuinely a turnaround practitioner, they will find the cash for you to be able to afford them, to be able to turn your business around.
Yeah, great point. Well, that's great. Some great insights, Macaire. Michael, thank you very much for that. So we'll have some questions, no doubt, from the viewers. So I'll just hand over to Megan Stewart, who's been moderating today, to facilitate that.
Yeah, look, so we've got lots of questions in the bank, which is fantastic, but please feel free to ask them and we'll get through as many as we can. So I'll kick off with a relatively easy question. How long does a Safe Harbour plan need to go for? Is there an ideal time frame, a set time frame?
The beauty of Safe Harbour, you could be in Safe Harbour for 5 years. If as long as you keep assessing that your plan is still better than the alternative, you can be in Safe Harbour for multiple years. And it's designed that way. Actually, one of the learnings that we had along the way, our very first one, when it came time to exit, the client said, can we exit Safe Harbour now? And we said, well, yep, you can, absolutely, but why would you? Just keep the frame. There's no requirement for you to actually bring it to an end. You may as well just keep the checklist going and stay protected all the way through. So, and as we all know, it's designed to be private, so you don't have to tell anybody other than your incumbent financiers, and you don't have to, but you always recommended you do. So no, you can be in multiple years of Safe Harbour protection. And then it kind of just peters out. But all the things you're doing are all best practice stuff that you should be doing anyway. Yeah.
So the short answer is, as long as you need it, and as long as you need it, just make sure you're complying with the framework.
The only caveat to that is if you perhaps are listed and it's in the market already that you're in Safe Harbour, and we've seen some listed companies use it as a tool to try and assist their sort of cram down discussions with creditors, then you obviously want to actually tell the market you've now finished Safe Harbour, because again, it's a confidence booster.
Although remember that Safe Harbour is, and I say this in my article for all of those who have read it, it's a verb, not a noun. So it's a series of actions, it's things that you're doing to ensure that you're engaged in business improvement and focused on improving your business whilst you comply with the technical aspects. So remember, firstly, you don't have, this wasn't the question, but it's not disclosable, but what's disclosable is the things that you're doing in accordance with your usual listed disclosure obligations. And so, you know, to the extent you believe as a board you need to continue to do those things, then you are technically in Safe Harbour. As long as, as soon as a board, you take the view you don't need to do those things anymore, but you are always focused on business improvement. You always want to lodge on time. You always want to pay employees. But technically as a board, you're no longer relying on it, even if you are continuing to do the things that it requires of you.
That was an easy one, Megan. How about some tough ones?
Yeah. So if you want a toughish one, somebody's asked, under what circumstances would the use of Safe Harbour be appropriate? So if the company is deeply insolvent, it would seem futile to even spend money on advisors to develop a restructuring plan or even consider Safe Harbour as an option.
No, I mean, it's fine. If you need a bit of time to say the business model, you've taken on too much water and the business might need to go through a VA process. Going to Safe Harbour now, if you still think that a properly planned VA is still going to be better than an immediate VA, then that can still buy you critical time to actually use it for protection through that pre-planning phase. So
yeah, it's funny, we got asked a similar question just yesterday, and I said, you know, we promote early intervention. We want people coming and seeking out advice as early as possible, because the sooner you get good advice, the easier the plan is to deliver on. But unfortunately, we live in a world of people do still come quite late. So in fact, we deal mostly with deeply insolvent entities that are in really significant crisis. And yet we are still able to deliver, you know, 90% of our roles, we deliver turnarounds. So, so insolvency isn't an impediment to delivering on a turnaround.
It's just a reality. It's just always there.
Yeah.
If you're not insolvent, you're in that grey area.
Yeah.
And that's human nature, right?
That's right.
Directors never put up their hand early enough.
Yeah.
But Safe Harbour is helping that conversation happening earlier.
So it's not an impediment, and there's always a way through. And it may involve a pre-planned voluntary administration, absolutely. But it may also involve a turnaround, and as I said before,
Or a combination.
Or a combo. And as I said before, the art of turnaround is pushing out the cash wall. So no, you know, there's no too late to seek advice and access Safe Harbour.
Great. All right. We've got a couple more questions on the financier side of things. So someone's asked whether the financier should be involved in developing the plan. Should they have input in the plan? Should they approve the plan?
I mean, they can't be involved in the plan because that puts them into a compromised position. But the prudent chief restructuring officer, tenant advisor, engaged advisor, whoever, should always inform the financier group, absolutely, on what the plan is, and in our advice, should always tell the financiers that you are availing yourself of Safe Harbour, again, because it's a confidence tool, and they get confidence out of that. So but they can't. You know, they can say we're happy with the plan and we're happy to give you covenant waivers or forbearance deeds, whatever, based on what you've delivered. But that pre-Safe Harbour, that's what you're doing anyway.
Yeah.
If you're doing this, for a living. So it just
Yeah, as a key stakeholder, you will be going to them with an ask, and they need to agree to the ask as it affects them. The benefit of having, a CRO, turnaround expert, however they're labelled in the context of Safe Harbour, is that the bank or the lender knows the information they're getting is transparent and honest. So it's just easier to deliver on the plan. But the financier's role is literally to consider it from their perspective and consider whether they're happy, taking everything into account. You know, we will always give the financier the transparent options. You know, here are the different things that we've been able to consider in terms of the art of the possible. And now you as the financier need to give us feedback on which is palatable to you.
Yeah, it's just, Safe Harbour hasn't changed a normal turnaround process. It's just an overlay, right? You know, the financial will give you feedback, no doubt, right, on whether the plan meets sort of their appetite. But you know, they won't officially endorse it, but you know, they'll agree to covenant waivers and letters of waiver, or whatever it might be. But they can't be involved in it per se. But yeah.
So just to, I guess, round out that question, that the same person's asked a follow-up question in how does Safe Harbour actually protect financiers? So obviously in a scenario where the plan doesn't work and the company might inevitably...
It's the de facto director.
Yeah,
so we start with de facto shadow director issues. And I think there's definitely pre-Safe Harbour some awareness. You know, it's not a big issue in Australia, but we do have court authority that banks can be shadow or shadow or de facto directors. So of course, Safe Harbour protects directors. So that's the board of directors, anyone else in the company who is an officer in the role acting in the management of the company that is construed to be a shadow or de facto director. The advisor, which gives us confidence, acting as CRO or interim CFO, being roles that we will routinely take with our clients. And then of course the bank. So anyone who is exposed to that sort of director risk is protected by Safe Harbour.
And the overlay on that now, the creditor defeating disposition legislation, which means anyone involved in the transaction can be sued or held criminally liable for you know, if it was deemed that that transaction was for undervalue. Now it's going to be difficult to try and determine, you know, whether you did that in this current climate, but again, it just provides a blanket of cover for anyone involved in that transaction. So it's not just directors who are caught; it's advisors, potentially financiers. So again, what you're going to see more and more a prerequisite that you are in Safe Harbour if you are offloading assets quickly for cash or whatever it might be.
Yeah, so that's your distressed M&A. We're actually seeing this as much broader than just the company that needs the turnaround. If you're engaged in some sort of distressed M&A or disposition, so that goes to the corporate lawyers that might be on the line, you need to be thinking Safe Harbour just to give that disposition, that transaction, an additional layer of protection of being unwound.
Okay. So we've got a couple of questions about who should play the role of a Safe Harbour advisor. So one person's asked whether the auditor should play the role of an advisor, and we've also got a question about, I guess, in our view, are insolvency accountants better placed to advise on a restructuring plan than lawyers or restructuring banks, say, especially if there's a small budget? So sort of ignoring the bigger end of town, this is more mid-market, but yeah, who should play that role?
One of the shortcomings, unfortunately, of the framework is they didn't define, you know, the qualified entity, the Safe Harbour expert, tightly enough. But it's like, as we've seen, you know, some lawyers can take on the QE role, the qualified entity role, but they're then always supported by an insolvency restructuring turnaround professional because they can't provide the financial rigor and because you need to, you know, at the end of the day, you need to have demonstrated, and it's always going to be in hindsight, you know, did you have a considerably qualified turnaround team around you, restructuring team, that's credible in the market. So your plan can stand that test from a future liquidator. So, you know, an insolvency person can play the role, a specialist turnaround firm can play the role. Anyone can play the role, but you need to make sure that that team, I mean, we look at the Safe Harbour appointment as a Safe Harbour team, should always involve the lawyers and a suitably qualified insolvency restructuring turnaround professional acting as a team to provide ultimate protection.
I think I was a bit of an advocate of the very broad definition, so I must say that was partly me pushing that. And that was from my experience in the UK, where one of the best turnarounds that I worked on there that we delivered was where the CFO was formerly a turnaround practitioner and was now in the executive team, and he drove that project.
Yeah.
And because of him that it was successful. So, and that was an executive that was currently in a team, and I know that the Safe Harbour role that I had earlier this year, in fact, we had both the chairman and the CFO there have outstanding prior experience in turnarounds. So to answer the question, no, not the auditor. So
No.
Definitely not the auditor. That's an absolute no. But then who? Well, in a really tiny deal that we did, I say really tiny, sorry, in an SME deal, for example, Kevin, that was all that was required there, and that was what was required there. Conversely, in other deals, we may work very, very closely with the legal team to provide that support. And then on the very, very large institutional deals, we'll work with a number of advisors. So there is a solution for every market, and it's going to be the flexibility in the regime allows you to be quite bespoke about who do we bring in, who is the right person. But the one last thing I'd say on that is, as a board of directors or as an advisor bringing someone in, you want to see their CV. And they have to have delivered turnarounds before. You know, if they've never actually successfully turned a company around, then you need to go find another person, because you're looking for someone with expertise in that. So that would be my one qualifying comment.
Yeah, I mean, it's all about, if you end up in liquidation, making the job incredibly difficult for the liquidator to try and attack whether you're in Safe Harbour or not.
Jobs.
So and saving jobs. But if you've got, you know, someone who's done multiple turnarounds, et cetera, et cetera. And one of the key things that certainly in our pack and always recommend every company or advisor do this is what's called a security statement. That's your definitive black and white test. Every month, always update that. And that shows you black and white what the return to creditors would be in a turnaround under the current plan or plan VA even versus immediate VA liquidation. That should be on file every month, updated. So that's your definitive black and white test to show that it was still a better plan.
Can I add to that? That is the definitive litmus test. However, as you get closer and closer and closer to that sort of sense of, so it can get, when you're well away from that and the plan's planning better, it's easier. As you get closer and closer to that day where it's less clear, it becomes, there are some other considerations that you need to bear in mind. And that is actually drilling into, what are we trying to achieve? And is what we're doing actually going to achieve it? So if we're trying to achieve a moratorium on creditors, are we actually going to get our moratorium from the specific suppliers that we need it from, yes or no? And if the answer is, oh, we're going to get a general moratorium, but not for this major party, then actually think again. So just once you get close to the time, there are some nuances to be a little more careful, you know, in terms of your thought around.
Great. So conscious of time, we'll probably leave the questions there. We've got a few unanswered questions left. So if they're not anonymous questions, we'll send you an email with our response to that. But just before I hand back to Kevin, we'll close out just with one last question. It's the $1 million question at the moment and not specifically related to Safe Harbour. But do you have a view or a feel for the continuation of stimulus packages like JobKeeper, etc., post-September?
Yeah, I mean, the latest intel we've got is that there certainly won't be any extension of the insolvent trading relief, because the government and Treasury are very concerned about zombie companies. So expect that to finish then. Certainly there was talk early on that there might be a freeze on preference recovery through this period, because it's going to be very difficult for creditors to say that they weren't aware that their client was in some financial difficulty. That doesn't seem to be, it's not going to be touched at all. Just another couple of points on that. We understand that there may be a moratorium put on litigation lenders. You know, that might be coming out soon. That's certainly being kicked around by Treasury because they're worried about, you know, the whole continuous disclosure issue, and it's incredibly difficult to stay on top of that through this period, obviously. So there may be some implications there. But JobKeeper certainly, I mean, the government is very aware that finishing it, you know, in September is going to be horrendous. I expect to see some tailored industry-specific JobKeeper extensions. That's certainly our expectation. And we'll obviously hear more about that, you know, in July as the review gets completed.
Great. Okay. Well, we might finish there. So thank you, everyone. Thank you, Macaire. Thank you, Michael. We really appreciate your insights there.
Just one other, sorry, give me just one last thing just to leave with. I mean, turnaround is a game of confidence. You know, Safe Harbour is a confidence enhancing tool. That's how you got to view Safe Harbour, right? And all the stakeholders around you. And, you know, if we're not in it already, we are heading into a credit crunch, right? So your ability to attract capital, which is going to be critical for all of these turnarounds, is going to be how do you get to the top of the pile? Because either incoming financiers are going to have a plethora of deals to look at, incumbent financiers are going to be inundated with files as they already are. So how do you get to the top of that pile and get the attention needed so your business can succeed? So Safe Harbour is going to be a tool to help you stand out from the crowd, which is going to be critical. So we are heading to a credit crunch. I mean, you know, indications are that 60% of all trade credit, debtor insurance applications at the moment are being knocked back. So that's going to flow through, and there's the inevitable credit crunch coming as the banks have to start picking winners and losers. It's just unfortunate reality of any recession or even worse that we're going to go into once those support mechanisms come off.
Yep. No, it's an interesting point, Michael, and I guess it'll help the credit team get their head around a deal faster, because if you're in Safe Harbour, you know you've got your tax paid or reported, employee entitlements up to date, you got a plan, you're ready to go. So it's a really big confidence tool, as you say. Right. Well, so coming up in a couple of weeks, we've got leadership and culture aspect of our fast track process. We've got a psychologist, Chantal Korish. We'll be identifying symptoms and coping strategies for you and your staff during the isolation time. So last kind of few months has been mental health's been a massive issue. Strategic planning, we're going to be interviewing CEO of Evolve Group about his reshoring journey of transferring business operations back to Australia. Again, very topical. Michael's also going to be joining us again a bit later on strategic planning, how to survive the COVID recession. So discussing with the key principles to follow to ensure that you're a much stronger position to not only survive, but to take market share from your competitors who aren't adapting these best principle practices. So we're going to have any further questions, contact us directly. And we're going to have the webinar on our website if your colleague has missed it. So thanks again for joining us today, and we will see you next time. Goodbye.
Pleasure. Thank you.
Thank you.